Here is our look at the stock market for the S&P 500 and the Nasdaq, looking out the next 1 to 3 months. So last week we showed the short term on the Nasdaq, and we thought it would come down into sometime midweek and then begin to rally again. That has happened. Now what I want to show you is the a little longer term view, and I'm going to look at the S&P 500 and the Nasdaq. And the real focus right now is has the market actually set up a bigger correction, or is that just a little correction we saw and it's about to explode to new highs again? Well, if you look at the market today, you might say, well, it's all over and it's ready to start to move up again. That little correction we had was it, and the buyers are back in control. But I have a lot of doubt about that. And when I look at the mega cap stock patterns, stocks like Apple and Microsoft and Facebook and Google and Amazon, those stocks have got corrective periods out in front of them. And it's very likely we're going to see them start. Amazon is actually a really bad looking pattern, and some of the other ones have just given little signs of rolling over, but not that significant. But they point out into September and even towards the end of September for some corrections. And I think that is going to be leading the market into a sharper correction than we've seen so far. We had looked for the stock market to correct starting late June, early July, and then correct into August, but then we saw these patterns extend, and the mega cap patterns extend, and that really pushed it out into September. We just respond to what the market shows us. Let's move off of JD there and move into SPX, the S&P 500. So here is the cycle analysis on the S&P 500, and what we're looking at are the cycle rhythms on the bottom. There's a minor cycle, an intermediate cycle, a major, and a super major cycle way out over here. When all three of these are in alignment, there should be a big correction. That happened way back over here. I'll just blow that out a little bit more. As you could see, as we got into that period in the pandemic, and there were all of these alignments to the downside that just coincided with that pandemic. It made it very risky on the downside, those alignments. And now where we are is right in here, where we're getting this hanging man. I want to say hammer, but I've got people writing me that about hanging man versus hammer, and a hanging man is at the top, a hammer is at the bottom. And this pattern right over here, a hanging man, is when the body is about 1/3 of the size of the tail, as you can see right in here, or the shadow. And what the hanging man means is that the buyers are likely to get hung. So that's the pattern we have right now, and this happens at peaks often, and it happens at bottoms often, where you have a lot of buyers come in after big declines. When you're at a high of the market, it is a hanging man and is warning that there is likely to be some further correction to the downside, further movement to the downside. So this time frame in here extends out into September, and we originally were pointing to a decline, and then we revised that. So this yellow zone over here was originally, and these projections were pointing down to an 11% decline into August, and that was revised to 5.3 to 7.7% decline, and we're projecting that now into mid-September based on the mega cap patterns. So we expect that this rally that we're having right now will begin to struggle. It is likely they will take out new highs before they move back into this corrective phase over here, and it is likely that we will see at least a couple of weeks of sharp downside moves sometime out here in September. September seasonally is a month when there are often some sizable declines. I want to say that because of this translation, a 24-week high, that is exceptional strength, and we have this really good upside momentum. What it says to us is that were we to continue this correction as we expect, then when you get past this period here, you get into another rally phase, which should take you out some couple of months yet to even higher levels. So we're looking for a correction in here. which relatively modest, 5.3 to 7.7%, and then another upside move. When I look at the Nasdaq, which I think is going to lead the way on the downside in here, it's really interesting because it has 3 hanging men right in there. Let me just get that message out for you to see. There are 1, 2, 3 hanging men in the market right over here as it gets up into the fib extension. And this time frame that we're looking right in here, we were looking for a minimum decline of 13% from the peak, and that was revised to 5 to 8% on the downside. And based on the mega caps, we're looking for it to come down into the mid-September period. 1, 2, 3 hanging men going on here. It means the last 3 weeks you get all of these buyers that can't make the market go to new highs of any significance at all. Still momentum strong in here. We would expect that it's going to roll over by a little bit. But again, the probabilities are that after you get a pullback here into September, that it will be moving up again to new highs. So very unlikely that we're going to see any kind of a bull market peak for some months based on we're looking at that. So the 1 to 3 month view for these indexes are down for about a month and then up for a couple of months is what it really looks like. And once we have our anchor points in here, we'll be able to project as to where we think the upside is going to be in there. Didn't want to do that. So that is a look at the Nasdaq. Overall, we're looking for this rally that we're getting in the stock market to nudge out new highs and then begin to peak again and move to the downside with a lot of risk, in our opinion, in the market for the next at least 3 to 5 weeks. If you didn't watch it, watch our analysis we did earlier in the show on China, the China syndrome, where we showed the relationship between China and the stock market here in the U.S., and that it is likely that it is going to be meaningful in a negative way for the U.S. stock market, maybe for world markets. Maybe that's why interest rates are so low. The bond market is moving up, and why the dollar money is moving into the dollar. All of those things are important factors in here for what we think will be a period of a lot of choppy and much more volatility, choppy markets and much more volatility going forward.